Tax planning is crucial, but even the pros can make mistakes. Today, I'll share 3 tax planning mistakes I made as a professional, along with 3 common mistakes I see my clients make, plus how you can avoid them. Welcome back to another episode of The Cozy CEO. Well, hey there. I'm Kimberly Ferguson, CEO and founder of Emerald Expectations Accounting. I'm so happy that you're here. The Emerald Corner is a place where owning a business means building a life you love, not sacrificing one. Today, we are covering tax planning mistakes that you'll want to avoid based on both my own experience and that of my clients. Now, as a Cozy CEO, your goal is efficiency and balance. So, smart, proactive tax planning is a key part of keeping your finances in order without the stress. So, let's jump right in so you can make sure your tax planning is as effective as possible. So, my mistake, number 1, is not taking your personal situation into account. When I started tax planning, I focused heavily on minimizing taxes. I wanted to pay 0, right? But I completely overlooked my personal goals and how they would fit into the picture. So, for example, let's say that you're looking to qualify for a mortgage or making a large purchase. Your reported income matters in that situation, right? So without considering your overall financial picture, you could reduce your income too much and then affect your ability to reach those personal goals, right? So make sure that when you're tax planning, it is tailored to both your financial situation and your goals in life. So my mistake number 2 was overdoing it. So kind of in line with number 1, but another mistake that I made was taking deductions too aggressively. So while deductions can obviously save you money, too many can make your income disappear very quickly. And this can impact things like loan qualification, building good credit profile, etc., right? And while tax savings are important, finding a balance is key. So make sure that your approach to deductions supports rather than hinders your larger financial goals. Now, mistake number 3 was not budgeting for the costs of tax reduction. Reducing taxes isn't always free. In fact, it's rarely free, right? Certain strategies require upfront costs, whether it's software, professional advice, investments, and retirement accounts, etc., right? Early on, I didn't factor these costs, which affected my budgeting. So make sure to set aside funds specifically for these expenses so the tax savings don't come at the expense of your cash flow. Now on to client mistakes. So number 1 is waiting too long. One of the most common mistakes I see is clients waiting until tax season to start planning. The truth is that effective tax planning happens during the tax year. So if it's 2024 and it's November and you're just now starting tax planning, you're running out of time. Yes, you can make some last minute moves like contributing to a 401k, but real tax savings need to be implemented early on. So waiting too long really limits your options and is going to result in you missing out on some potentially really good savings. So number 2 is thinking everything applies to them. Thanks to social media, our friend TikTok, there are a lot of different tax strategies already out there on the internet, right? And I see clients following these tax tips from TikTok or other platforms and assuming that everything they hear online applies and assuming that everything you hear online is legitimate, which, spoiler alert, it's not. But the tax laws are complex. I mean, have you seen how big they are? They're like thousands of pages long. So what works for one person might not work for another person. So I always recommend consulting a professional to see if a strategy is truly relevant to you and your situation. And then the third mistake is thinking tax planning is included in your tax preparation. So many clients believe that tax planning actually happens automatically with tax preparation. But the truth is they are 2 completely different processes. While most tax preparers are actually genuinely focusing on maximizing the deductions, what they're working on is the prior year. And real tax planning happens during the calendar year that you are actively trying to lower your liability for. So like I said, if you're planning for 2024, it needs to happen in 2024. You can't be doing it in January, February, March of 2025 and expect to have any tax savings for this year. So if your preparer is handling your taxes after the year ends, like we do, it's already too late for planning. So working with a strategist during the year ensures that you can have an intentional plan to reduce your taxes. Well, thank you so much for spending just a few minutes of your time with me today. I hope these insights help you avoid some of the most common tax planning pitfalls. Remember, effective tax planning is tailored to your goals, done early, and focused on strategies that actually fit into your life and business. So I hope you have a fantastic day, and I'll look forward to seeing you in my next video.